Hey everyone, Douglas here, Candid Market Analysis. It is Thursday, December 27th, 2018, 12:27 a.m. Eastern Standard Time. And this evening we're going to discuss all things macro. And really what I want to do this evening is make my case, if you will, build my argument that likely what we saw today was the bottoming and ultimate reversal of the current sell-off, and that there's a very high likelihood that we are heading much higher from our current levels right now, and likely pushing into new all-time highs in the not too distant future from here, and kind of build that case for a blow-off top here into primary wave 5. So like I said, we'll have a lot of macro points to look at, cover sentiment, cover some indicators, and kind of cover the macro picture as a whole, and then discuss positioning and kind of the trades that I made and why I made those today. But anyway, let's start off with the chart here, though. Just a real quick kind of recap of where we're at in the very longer term perspective, since we're likely in a major, potentially at the point of a major change here in terms of direction. But I have us all the way back in the 2000 highs at a cycle wave 3, and then the 2000 and 2008 downturns being an ABC pattern for cycle wave 4 here, meaning that since the 2009 lows, we've been in a cycle wave 5 impulsive pattern to finish off what would be then the super cycle from the that'd be the 29 lows. Or whatever that was, whatever the lows actually came in, 33. Anyway, more to the point to where we're at. Obviously, we have been thinking that we're in some sort of primary wave 4 pullback here, looking for some sort of completion. And like I said, I'm feeling pretty confident that we have likely bottomed in this current primary wave 4, meaning that the expectation is that we're going to be pushing to the upside here over the coming time period. So that is the overall look from Fibonacci standpoint. We'd be looking for a 1-to-1 ratio between waves 1 and 5, and that would bring us up to 4,700. Obviously, that would fit with a very blow-off top sort of scenario. Will we ultimately get there? That remains to be seen. Could we easily do a 1-to-1 618 between 1 and 5? Absolutely. We won't exclusively rely on those fib targets. Obviously, we have other tools in our toolbox to choose from to try and better pinpoint that. But in a classic Elliott look, from a Fibonacci standpoint, that's what we would expect. So again, not set in stone, not 100% that I think we're going to get there, but there is a certain possibility within the framework of Elliott that is what we end up reaching. So that's what I'm looking at for the S&P right now, and we'll get an Elliott update in by the end of this week, and we can kind of dig down a little bit more into the nitty gritty here. But suffice to say that we are bouncing at a pretty good spot. So let's talk macro, and where I want to begin is with really sentiment, and the bear sentiment readings that are out there right now are at near historic lows, or I should say historic highs, and just don't fit with the overall macro picture. And that's eventually what I'll kind of end off on. The State Street Investor Confidence Index came in at 79.8 today, and or yesterday now. And this is the lowest reading, I think, ever on this index, at least since 2011. I don't believe there's been a lower reading than this. And I'm not going to read too much into any one of these indicators, but when these sentiment indicators, but when you start seeing this sort of bearish, if you will, knee-jerk reaction, well, not knee-jerk reaction. I mean, it is what it is. But this sort of bearishness, especially in the face of, I think, what the macro picture is, it just screams kind of capitulation, if you will. There might have been too much bullish sentiment not too long ago, and now there's too much bearish sentiment that just doesn't add up. And one piece of that is going to be State Street. Another one, just to kind of keep these going, is the AII or AAII bearish indicator. Percent bears, and again, we're hitting those 2016 numbers in terms of bearishness. You can also see the exact same thing if you pull up or look up on Twitter the Bank of America Merrill Lynch bear bull indicator. The bearishness of it is through the roof. So the case to be made, the bear sentiment is extreme here, is quite easy to make and quite prevalent, and it just doesn't add up to the reality of where the economy, where the overall economy is, especially in the U.S. There are definitely issues in Europe and in China that are far more pressing, but in the U.S., which still drives, obviously, a very important chunk of the global economy, we just seem to have reached extremes. So there's kind of no surprise that we hit this bounce when we did, and it kind of took off with the veracity that it did. So what I want to do next, now that I've kind of listed off some sentiment indicators that really show extreme bearishness, I want to look at just a few kind of indicators, breadth indicators, if you will, that just show, again, just the extremeness of the current selling. What we're looking at right now is the percent of stocks above the 200-day moving average, and we're only at 13% right now, which obviously, as you can see, hits at levels that have been some kind of historic bottoms over the last decade, obviously 2009, 2011, 2016, and now where we're at today. Again, just massive bearish readings, and this is the sort of stuff you'd want to see upon reversal. And obviously with the bounce today, it helps kind of confirm that we might be getting close in terms of a bottom here. With the current move and some sort of reversal. So you have that. Another indicator too on the S&P in terms of the weekly RSI. We haven't seen this low of level since, again, to those 2011 lows, and only the second time in the past decade since that 2009 sell-off, or the 2009 lows, that we've reached essentially oversold territory in the S&P. And again, each time we've done that, it's coincided with a reversal in the not too distant future. So, from a kind of technical indicator standpoint, we're looking very oversold. Also tapping the 200-day weekly moving average as well, finding support there. So, look, are there still hurdles? Could some potential impeachment issues create some selling? Are there other things? Yeah, there are. But in terms of kind of sentiment indicators, we're about as bearish as you could possibly be. And again, like I said, in just a second, I think I'm going to make the macro case that we're not anywhere near where we were in 2000 and 2008, or even 2000 for that matter. So first thing I want to look at to kind of make that case, now being kind of the more macro case, is going to be the ISM, or the PMI. Manufacturing, and again, we would be wanting something far closer to the 50 zone than where we're at right now. So we're just still too early in the kind of, I would say we're in the end of the cycle, but we're still too early in that end of the cycle to again really call for a true recessionary environment similar to 2008. Again, not to say things aren't, well, we're not in 2017. Let's put it that way. We're not growing and expanding, but certainly the cycle is starting to roll over. Let's see some other things that just aren't quite there. Consumer credit is continuing to actually grow, so we're seeing an increase in credit. We want to see this rolling over and pushing down. We're just not seeing that. Another one, bank credit, actually accelerated during the last during the last couple of weeks. So we're seeing an acceleration in bank credit. Again, the sort of things that you're not going to see into a major sell-off or a major period of contraction. These are the sort of elements that you're going to see leading up to a really kind of a blow-off top, kind of irrational blow-off top. Let's see another one. Outstanding leveraged loans, again, continuing to accelerate, and again, just not the sort of thing that you'd expect to see if, in fact, we were going to be having some real issues, financially speaking. One other thing to look at, or one other kind of final indicator, is the federal income channel. Again, just not seeing anything there that says we'd really want to be much closer to say where we're at in 2000 to really indicate any real stress, and we're just not getting there yet. I would expect, now I'm going to expect all these to eventually roll over. That is definitely it, but we're just not there yet. We're more in that situation where you get those kind of blow off tops. And those blow-off tops, let me switch back to the S&P. Those blow-off tops are really going to be caused by the sort of environment you get in kind of the end stage, if you will. They get caused because the kind of credit situation really creates a situation where speculation gets rewarded almost, and that speculation is oftentimes debt driven. And this is something I've spoken about quite a lot. As many of you know, I follow Steve Keen, and his work has definitely educated me and instructed me, and I would consider myself a Keynesian, not Keynesian, but a Keynesian. And real quick, here's a more recent video where he discusses kind of his overall theory. Keynes uses, or Steve Keen uses, complexity theory along with kind of a nonlinear model to demonstrate how really the private debt growth and contraction is at the heart of the business cycle. So I will put this link to this in the I guess would be the note section of the video below. On the Patreon side, or on the Patreon post, but definitely check him out, and if you're interested in kind of the nuts and bolts, if you will, of the mechanics of how the economy works, and how I also kind of piece all this together. But the big takeaway is his model fits very well within kind of a Minsky framework where you get late stage kind of irrational exuberance. Ponzi finance is what he'll call it, where you, I mean, essentially what happens is banks get themselves in a scenario or lenders get themselves in a scenario where they have to chase higher asset prices, otherwise they go bust. So they are effectively insolvent. They just, as long as the asset prices continue to go upwards, they don't have to essentially go bankrupt, and so that's how you get these end stage blow off tops, and like I said, he'll explain that more in that video if you want the nuts and bolts and the mechanics of how that all plays out. So well worth the time to watch that. But I do think we're at that point within kind of this economic cycle where we are going to start to get a scenario where we see a reacceleration, a final acceleration of credit into a kind of diminishing federal spending situation. So we're not getting that income channel to offset the credit expansion, and that just creates a classic bubble environment, and then collapse, I guess, after that. So let's see. I think that is kind of the majority of what I have to say in terms of kind of my case. I also think too that with the I can switch to the dollar real quick. With the stronger dollar, relatively speaking, I realize from our tops in 2016 we're down substantial amount, but I think we're still rising, and we'll likely get another leg soon. But all in all, with a stronger dollar, relatively speaking, that creates a scenario where U.S. equities look more and more enticing relative to the rest of the world as well. So I think that could definitely spur on global capital flows into U.S. denominated assets as well during this next kind of cycle. Let's see. So finally, the last thing I want to talk about is really just positioning. I went ahead and shut everything down today except for that dollar long. I think that's still the right play. And I also started to build out a potential long position in stocks. I feel like I got in. I think the S&P was up about 2.5-3% when I got in. Obviously, it made another 2%, so that was a good spot. But I feel pretty comfortable with where I'm getting in, and it's pretty minor. But I'd love to build out. If I'm right here, and we end up turning over here and pushing higher, or rolling over and pushing higher here. I'd love to build out into probably over 50% SPXL, maybe into 60%, if not higher, once we really get good confirmation. So I figured what a better spot now to go ahead and do that. In terms of the other positions too, obviously the long bond and the junk bond spread played out nicely, took great profits there, and happy with that. Could I possibly milk out a little bit more? Yeah, likely. Do I think TLT could still go higher? Absolutely. But I'm happy with where I'm at, and at this point, I made what I thought I could in those, and so I'm happy to move on from that trade. In terms of gold and nugget, ultimately, I think those were about break even. A little disappointed, but and I still think gold has the potential for the next 6 months or so to continue to push higher, but it's just one of those that's not worth the risk now, I guess, at this point, and I would really rather be more focused on equities going forward here than trying to grind gold a little bit higher, if you will. So that was kind of the overall thought. If we get a break in the dollar, a little bit higher break in the dollar here, then I'll likely add on to that position as well and get that kind of expanding out once again. So yeah, that's kind of the thought. One other thing too, I guess, that I completely forgot to mention is on top of everything else, to again just kind of make for that argument. I talked about that 42 level being very important for oil, and boy, did we ever bounce off that, up almost 10% within the day, and again just showing that there might be a change here underway. And obviously that's exactly what we want to see in oil is a move like this to go along with that whole the sky's no longer falling case, if you will. So yeah, in terms of getting long oil, I don't know if I'm quite ready to do that yet. I think the situation will present itself soon, but at this point, not quite ready to do that. And it might be a while too before I think that situation really emerges. So yes, let's go ahead and wrap up this macro update here. So any questions, feel free to send them my way, and any thoughts, feel free to post them. And always enjoy reading over those. So good trading, everyone, for the rest of this week, and like I said, we'll get in an Elliott Wave update either tomorrow night or the next before the end of the week. So good trading, and we'll see you next time. Bye bye.